Hello, everyone. Thank you for joining us in this webinar today. I'm going to let people trickle in for a few more moments, and then we'll get started. All right, so it's 1 p.m. here. We're going to get started. Hello, everyone. On behalf of the Environmental Finance Center Network, welcome to our webinar today on long-term investment strategies and concepts for financial resiliency. My name is Maya Bani from the Syracuse University Environmental Finance Center. And before we begin here, we're going to go over a few housekeeping items, and then we can get started. During the training today, everyone will be kept on mute to ensure audio quality. If you have a question, please type it into the GoToWebinar question dialog box anytime throughout the session. We will be saving questions for facilitated Q&A at the end of the presentation, or if you have questions throughout, we'll be more than happy to answer them. After the webinar, you will receive a follow-up email that includes a link to the recording and other information you may need. You can also download the slides from today in the Handouts tab in your GoToWebinar control panel. This session has not been submitted for pre-approval of continuing education credits, but eligible attendees will receive a certificate of attendance for their personal record. To receive a certificate for the session, you must attend for the entire session and register and attend individually using your real name and unique email address. Certificates will be sent via email within 30 days of the webinar date. If you have questions or need assistance, please contact our email smallsystems@syr.edu. Now for a little bit about us. The Environmental Finance Center Network provides training and technical assistance to small water and wastewater systems in all U.S. states and territories through our building, technical, managerial, and finance capacity programs. If your community or utility needs assistance with drinking water or wastewater system management, please feel free to contact us through our request form, which I'll be sharing shortly in the chat. And on that note, we can get started, and I'd like to introduce our presenter for today, Andrew Waters. He's a project director at the Environmental Finance Center at the University of North Carolina.
Thank you, Maya. I hope everyone's having a good afternoon. I'm coming to you today from Spartanburg, South Carolina. Pleasant fall weather here. I hope you're enjoying some of the same. You have my contact information here. I will be showing this information again at the end of the presentation, but of course, feel free to follow up with me if you have any questions or any follow-up about today's presentation.
Andrew, I think we're just waiting on you to share your screen with us.
Thank you.
Mm-hmm.
Did that work, Maya?
Yep, it's perfectly clear. I can see it.
Okay, great. So this workshop will introduce wastewater managers to basic concepts for long-term financial resiliency and asset management. After a brief overview of some financial analysis tools that can help wastewater systems better understand their asset life cycle, we will focus on long-term planning strategies and concepts, including asset criticality, life cycle costing, and capital improvement planning. This workshop is designed for wastewater systems serving 10,000 or fewer people, especially targeting local government systems facing financial challenges. So in this presentation, hopefully you will learn how to understand financial metrics for long-term planning, understand some concepts of asset criticality, and then understand the relationship between life cycle costing, asset management, and capital planning. But before we get started, I want to warm you up a little bit and hopefully get some information about our audience today. So I'm going to go ahead and get started with a poll question. You see it here, but then now Maya is going to pull it up on the GoTo software. I think she said she's going to give about 40 minutes or 40 seconds, excuse me, to answer the poll.
All right, closing up poll 3, 2, 1. All right. So for the results here, it looks like we have people attending from all different backgrounds. 45% are in the science and engineering field, 26% other, 15% management, 13% finance, and 2% law.
Okay, great. Well, about probably what I expected. Not a lot of finance people in the room, but certainly the concepts that we're going to be going over today are designed for people with other backgrounds and other experiences, and to help you learn a little bit about kind of that financial management perspective of long-term resiliency. So just one more poll question before we go ahead and get into the presentation. Go ahead, Maya.
All right, so I'll be closing the poll in 3, 2, 1. And for how many clients does your system serve? The results were 61% not a system, 14% 2,500 to 10,000, 12% 501 to 2,500, 10% 10,000 and plus, and then 2% up to 500.
Okay. Well, certainly for those of you who are here from utility systems, most of you are from smaller systems. Some of you who are here that do not work for utility systems, hopefully some of these concepts will be helpful for you as you work with utility systems And certainly you will be able to know about some of the resources that the Environmental Finance Center network can provide to some of these systems. So let's go ahead and get started. And where are we going to get started are financial statements. So financial statements are a collection of summary level reports about an organization's financial results, financial positions, and cash flows. They typically include the income statement, the balance sheet, and the statement of cash flows, and they are written to provide a snapshot of a firm's financial status on a given particular day, typically the last day of the firm's fiscal years. So from a management perspective, financial statements are useful for the following reasons. They can be useful to determine the ability of the organization or business to generate cash and the sources and uses of that cash. They can help determine whether an organization has the capability to pay back its debts. They can help track financial results on a trend line to spot any looming profitability issues. And they can be used to derive financial ratios that can give us kind of an analysis or a kind of indication of the organization's long-term financial sustainability. So I'm going to go over briefly a few financial analysis ratios that we use quite a bit at the Environmental Finance Center network to kind of look at financial sustainability for utilities. And also lenders are also going to be using some of these ratios when they evaluate your utility for a loan or possibly a grant opportunity. So that's why it's helpful for you as utility managers and employees to understand how some of these ratios can be used. So from the financial statements, you can use financial indicators to view trends in your long-term financial resiliency. Key financial indicators are a way for a system to get a snapshot of its financial health and to determine whether it needs to make adjustments to its expenses, revenues, and rates. To enhance utility, key financial ratios should be calculated annually when the financial statements are prepared or released and discussed with your financial management team. One of the most important financial indicators is the operating ratio, which measures the ratio of annual operating revenues to annual operating expenses. To be a financially resilient organization, a system should strive to have at least as much operating revenue as it has operating expenses over time, if not more. Otherwise, the system would be operating at a loss. Evaluating the operating ratio over time provides a broader perspective on the utility's financial sustainability. At the EFC, we typically evaluate operating ratios over a 5-year term. Operating revenue includes the money the system receives for its services, including income from rates, tap connection fees, penalties, and other sources. Operating expenses include items such as salary, benefits, employees, treatment for chemicals, filters, insurance, anything, any kind of expense that the utility would incur over the course of the year. Hold on, I'm going to go back. So the operating ratio is the total operating revenues divided by the total operating expenses. Now, these expenses can include or exclude depreciation, and we're going to go over that in just a few minutes. But the operating ratio provides a broader perspective on self-sufficiency. It shows how efficient a company's management is at keeping costs low while generating revenue or sales. The higher the ratio, the more efficient the company is at generating revenue versus total expenses. So an operating ratio of 1.0 indicates that the utility's revenues are generally meeting expenses, while an operating ratio of While an operating ratio of 1.0 indicates a firm is at least covering expenses, you may wish to employ a higher minimum benchmark of 1.2 or 1.5. So sorry, I stumbled a bit there, but the point is that 1.0 is kind of a baseline for your expenses meeting your revenues. 1.2 or 1.5 means that you're collecting 20 to 50% of revenues over your expenses. So your net revenues are exceeding your expenses by that amount. So this is a recent example of an operating ratio calculation for a small wastewater utility. In this case, the firm's operating ratio is 0.95, indicating that its revenues did not meet expenses for the fiscal year. This is the same utility with depreciation, accumulated depreciation included in the operating ratio calculation. When depreciation is included in the calculation, it enhances the metric's value for long-term sustainability by estimating how well the organization is maintaining and replacing its infrastructure or planning for those measures. Including depreciation provides a more complete operating ratio because it includes measures of capital costs. This can indicate whether or not a utility is collecting enough revenue to maintain its system and capital assets over time at a current level of service or operation. So here is the operating ratio calculation for the same utility shown in this previous slide, this time including depreciation. Now the operating ratio is 0.57, indicating the utility is not collecting enough revenue to cover its estimated depreciation over time. A ratio of 1.0 in this case would indicate that the firm is covering the estimated loss in capital asset value in its net revenues. So as mentioned previously, looking at operating ratio over time provides a snapshot of a firm's long-term resiliency. On the right is the same firm's operating ratio over the firm's most recently available 5 financial statements. The operating ratio on the left shows the operating ratio for the same 5-year period, including depreciation. While the chart on the right suggests the firm is doing an okay job meeting expenses, the chart on the left indicates the firm is not collecting enough revenue to replace its capital assets over time. Days of cash on hand is the number of days the organization can pay its operating expenses using its cash on hand based on its unrestricted assets. So this ratio looks at how much time you can continue to operate in a crisis. It can help your organization decide if there is a need to make cutbacks on expenditure. And generally, it can help the organization. Generally, the organization wants to strive to maintain several months cash on hand, exceeding the billing period. So if your billing period is for 30 or 60 days, you want enough cash on hand at least to exceed that billing period. So you have a fairly good idea that your cash on hand is going to cover that billing period. However, We have a 2013 study that says median days cash on hand for AAA rated utilities is 427 days. So those higher rated utilities typically have many times billing periods cash on hand. And here's the calculation on your screen. It's just unrestricted cash and cash equivalents divided by operating expenses, excluding depreciation, and then you want a daily expense figure, so you divide that by 365. So basically, it's your unrestricted cash divided by what it costs you to operate for one day. So again, this is looking at that same small utility. In this analysis, there was a target days cash on hand set for 180. This utility's days cash on hand came in at 165. So they were a little bit below their target, but certainly above their billing period. And again, just looking at the trend of this ratio over a longer period of time generally gives us an idea of the organization's liquidity and its ability to pay its expenses in the short term. Debt service coverage ratio. This ratio indicates how well you can cover your debt after you pay your day-to-day expenses. It's calculated as the total operating revenue minus operating expenses divided by principal and interest payments on long-term debt. So this ratio, in this ratio, a ratio of 1 is the minimum needed to cover your annual debt. But lenders often require debt service ratio of at least 1.2. So that extra 20% would be a buffer for security and downturns that would make a lender feel more comfortable in lending you money on a long-term debt basis. So from that same study, median debt service coverage ratio for those AAA utilities was 2.7. And for AA utilities, the median debt service coverage ratio was 1.9. Now here's that same little wastewater utility that we've been looking at throughout the presentation. In this slide, the dotted line depicts the recommended debt service coverage ratio of 1.2. And as you can see, this utility has met this threshold only twice in the last 5 years. So this indicates the firm may struggle to pay debt, which is a potential red flag for funders and lenders. So we're going to talk a little bit more about depreciation now. And this ratio is the asset depreciation ratio. So this is the accumulated depreciation to fixed asset ratios, which is an essential tool for companies that want to estimate the general remaining usefulness of their physical assets. If the ratio is too high for comfort, utilities should plan to replace these assets. And the UNC EFC recommends a target asset depreciation ratio of 35%. So this indicates that roughly 1/3 of the organization's assets have already been depreciated. In this example, the firm's asset depreciation ratio is 39%, slightly higher than recommended. And again, here's that accumulated asset ratio over 5 years. This chart indicates the firm's accumulated depreciation has slowly exceeded the recommended 35% threshold over this period, indicating it needs to plan for more investment into its long-term assets. Okay, so we've been talking about depreciation, and what is depreciation? Depreciation affects the utility's property, plant, and equipment assets, excepting land. Over time, these assets lose both usefulness and value. Depreciation is the standard accounting method to account for this decline in financial reporting. In financial terms, depreciation is a non-cash business expense that is allocated over the useful life of the asset. So one of the things that we talk about at the EFC is this idea of fully funding depreciation. And basically that means that you're using that operating ratio figure to capture your annual depreciation into your projected revenues or your budgeted revenues. Now, this isn't as good as doing full-time asset management and capital planning, but it is better than nothing, and it does help you understand from a financial perspective how you can enhance your long-term financial resiliency just from those audited financial statements that you're getting year over year. And most depreciation is calculated on this straight line depreciation. So that means that a utility is evaluating an asset's depreciation over time and including that estimate in its financial and asset planning. By the time the asset is fully depreciated, the utility has enough money in the bank to replace it. So in this example, this water tank has a anticipated useful life of 10 years. It was purchased for $10,000 for simplistic purposes. We're just going to assume we can replace it for what we bought it for. So we're going to depreciate that tank $1,000 for 10 years in our financial statements. And our financial statements are going to reflect the accumulated value of all of these assets. Sorry, I got a little bit ahead. Here's the tank that we're buying for $10,000 and that we're going to depreciate over a 10-year period. So most of your audits, your financial statements should be reflecting depreciation in your financial reporting. This is just an example from a financial report showing depreciation. It tends to show up in different places. Sometimes I just do a search for depreciation and see what comes up. But this is certainly a recommended practice for your long-term financial sustainability. And if you and your accountant are not documenting appreciation on your financial statements, we recommend that you do so. All right, now we're going to shift and talk about asset criticality. Not all assets are equal in importance to the utility. And so critical assets are the organizational resources essential to maintaining operations and achieving the organization's mission. Asset criticality is the probability or likelihood that an asset will fail and the consequences of that failure. The two components of criticality are the likelihood that a given asset will fail and the consequences if the asset does fail. The types of considerations that go into the first determination, the likelihood of failure, are ways in which an asset could potentially fail, the condition of the assets, the age of the assets, its repair history, the historical knowledge of the employees and operators, and its operation and maintenance history. The second component of asset criticality is the consequence of failure. The components of consequence include the cost of repair, the social impacts or costs associated with the failure, costs related to collateral damage, legal costs, environmental costs, reductions in level of service, and any other cost or impacts associated with failure. One way to reduce the consequences of asset criticality is through redundancies. If there are redundant assets, if one of the assets fails, another is there to fill in. As an example, if there are 3 pumps that are available and only 2 are needed to meet the demand, then the third pump provides redundancy for one of the other 2 pumps that may fail. To evaluate asset criticality, we can use this type of chart. Each asset can be evaluated in terms of its individual probability of failure and its consequence of failure. The asset can then be plotted on a quad chart based on the probability and consequence. In this type of chart, the highest criticality or risk assets are those in the upper right-hand corner. The assets in the lower left hand are the lowest criticality or risk assets. The other 2 boxes are medium probability assets. So life cycle costing is the process of estimating the costs that the owner or producer of an asset will incur over its lifespan. These costs include the initial investment, future additional investments, and annually recurring costs minus any salvage value. In the best of all worlds, all assets would be replaced right before a catastrophic failure. If they are replaced any other time, money is wasted. However, it is not possible to actually know when to replace each and every asset, or even the exact optimal point to replace an asset. Therefore, it is necessary to use the concept of risk in determining when to replace assets. The graph can be explained by saying the graph shows the condition of a generic asset over time. The condition is not expected to decay in a linear fashion. It will decay in some nonlinear way. And one possibility is that it will be good for a while and then start to have problems, and then, of course, start to have lots of problems. The red X's show the repair needs or problem. The optimal time to replace this asset would be right before the real trouble starts, as shown by the blue arrow. If it was possible to predict this type of decay pattern for each and every asset, it would be easy to efficiently manage assets. However, this curve is extremely hard to predict because assets are long-lived and they perform differently in different settings. Okay. For high-risk assets, the asset should replace before they fail. This way, they can be replaced in a planned manner to minimize the consequences of losing the asset. Low-risk assets should be allowed to fail using the run-to-failure management strategy. These assets can be replaced after the failure occurs because the consequences of failure are low. The graph here shows the same asset as the previous slide. If that asset was high risk, it would be replaced before the optimal point. If it were low risk, it would be replaced after the optimal point. Keep in mind that we don't know the actual optimum point, so we are erring on the side of caution in the first case and erring on the side of not replacing soon enough in the second case, all based on the risk of failure. We will now shift to a discussion of asset management. At its basic level, asset management can be divided into two strategies: proactive and reactive. You can either maintain something to prevent it from breaking, or you can repair it when it breaks. In many ways, a reactive strategy can be either necessary or proper for asset management. In some cases, it may simply be impossible to access an asset to determine its maintenance needs. In other cases, it may be less costly to repair or replace an item only when it reaches failure. However, asset management is a strategy focused on a proactive approach to management. So here are the two different approaches: proactive and reactive. Either you repair, rehabilitate, and replace on a set schedule, or you wait for it to break. Effective asset management relies on long-term system planning for both your assets and how you intend to pay for their replacement and repair.
Several years back, we were sent to class and told to learn about asset management. I sure didn't know what the heck asset management was, as a brand new term. And I'm not sure why we're studying this. We got our own system and you can mind your own damn business. Well, we got to class and come to find out that what they're really telling us is that when something wears out, do you have money to fix it? And how long is it going to take before it wears out? And if you start saving now, will you have enough money by the time it fails to fix it?
Okay, Maya, did that video work? That did not do what I thought it was going to do.
I was able to see it. Yes, it played.
Okay, that was not how we discussed it, but it worked nevertheless.
Yes, it worked.
Okay. Okay. All right. So now we're going to take another little break and just kind of get some feedback from you on your infrastructure management approach. So Maya is going to give us another poll question that we're going to go ahead and answer.
All right, I'm gonna be closing the poll in 3, 2, 1. All right, for how do you maintain infrastructure? We have 57% say not a system, 23% said mix of proactive and reactive, 11% said mostly reactive, and 9% said mostly proactive, and 0% said all proactive.
Great. Well, obviously, all proactive is, you know, an ideal, and I'm sure that none of us are able to achieve that ideal. But it was nice to see some proactive responses on that poll. And certainly the poll showed what you would expect to see. Most of us are doing some proactive management, probably not as much as we would like, but it comes down to capacity and resources. Some of us are doing mostly reactive management. Again, due to capacity and resources, we're doing the best we can. But the overall point, kind of theme of this presentation is that if we can put more emphasis into that proactive approach, then our long-term financial sustainability, our resiliency is going to be enhanced by that approach. So at the UNC Environmental Finance Center, we organize asset management into 5 core components for training and evaluation. And you see these components here. The current state of the assets, the level of service your utility wants to provide and is expected to provide to your customers. This idea of asset criticality that we've already gone over in this presentation, and we're going to review briefly here. Same thing for this idea of life cycle costing. And then the final core component for asset management for financial resiliency is long-term funding. So these core components are compatible with EPA's advanced asset management training and the international asset management approaches from Australia and New Zealand. So as we finish up this presentation today and hopefully have a little bit of time left for questions, I'm going to go briefly through these 5 core components of asset management. Oh, one last poll. I think this is the last poll. So go ahead, Maya.
Closing the poll in 3, 2, 1. For your system's asset management, the results are 57% said not applicable, 26% said we're doing it, 15% said we plan to do it, and 2% said what's that?
Okay. Okay. Well, pretty good. That 26% is respectable. So good job for those that are doing some asset management. Some of these concepts may be review for you, but certainly we have some out there who need to think about asset management as a concept, broadly as a way to get started with some of these processes. So the first step of asset management is determining or evaluating the current state of your assets. Wastewater utilities use various methods for conducting these type of evaluations. For some smaller systems, this may exist inside the mind of a key operator or employee. Although this is a reflection of reality, we recommend developing some written system for inventorying these assets. That way, if the key operator leaves the organization, that institutional knowledge is still available. Obviously, these inventories can vary widely in detail and sophistication. Some systems use sophisticated database programs linked to GIS mapping tools, and some systems may use more rudimentary spreadsheets. The important point is not that you have to keep up with the most sophisticated technology, but that you develop your own system for inventorying and tracking your assets over time. So, the second core component in asset management is determining your level of service. In managing the assets, a utility needs to determine what level of service it will provide. The key question for a utility to ask itself is, what do my customers want? Taste, smell, quality, pressure. Likely all of these items are important to your customers. However, collecting specific feedback can help guide strategic management decisions and justify those decisions to your customers and to the public. Ideally, you want to involve customers and staff in the process of establishing the goals or service levels. The goal should be measurable, and can be either internal or external. External goals are those that directly impact the customers. Internal goals are those that are related to operations and that would not be easily understood by customers. This could be similar to a strategic planning process. In strategic planning, organizations typically survey their staff, stakeholders, and constituents and compile that information into organizational objectives and strategies for meeting those objectives. A simple survey could be another effective means for collecting level of service information from your customers and constituents. Today, online surveys are relatively easy to create using Google Forms or other widely available options. Information from surveys can be valuable and useful justifications for communicating capital asset investment needs. Progress toward meeting the level of service goals that are developed during the information collection process should be tracked and reported to upper management and the public. Again, some kind of planning document can be useful for benchmarking progress toward meeting organizational goals and objectives regarding level of service. However, tracking your customers' expectations is not only important for determining your own long-term investment strategies, it can also be an important tool for keeping your rates up to date. Linking costs and expenses to customer expectations can help your boards and/or elected officials justify decisions to raise rates or take on debt for important infrastructure needs. So core component 3 of asset management, again, is asset criticality. Although we have already talked about asset criticality, it is important to mention again here as part of your overall asset management strategy for long-term financial resilience. Determining which assets are most critical for repair and replacement in your system is an important component of your long-term investment strategy. Life cycle costing is the fourth component of asset management. So like asset criticality, life cycle costing is another important component of long-term investment that we have discussed earlier in this presentation. In sum, life cycle costing is the process of estimating the cost that the owner or producer of an asset will incur over its lifespan. These costs include the initial investment, future additional investments, and annually recurring costs minus any salvage value. Understanding life cycle costing, especially for your most critical assets, will help guide your organization's decision-making and ensure your most critical assets can be replaced before they fail, and help you plan in advance for that replacement. And so the final component of asset management is long-term funding. Long-term funding refers to your strategies for paying for your asset management. For some utilities, this could involve setting aside a portion of annual revenues for a reserve or capital asset fund. Again, including depreciation in your financial reporting and analysis can be an important baseline step for this type of saving initiative. For other utilities, this involves talking about this concept of the long-term capital and planning, also known as your capital improvement plan. This is where all of these concepts really come together. All of these 5 core components of asset management come together. Again, long-term capital planning is strongly related to asset management. However, this is an official multi-year document that identifies and prioritizes capital projects, identifies funding sources, and sets timelines for their repair or replacement. So this is really combining all of those elements with prices, with debt or saving strategy. Again, a capital improvement plan can take on different kind of forms or formats, but it includes individual capital projects, equipment purchases, and major studies for a local government with cost estimates in conjunction with construction and completion schedules and in consort with financing plans. So this is really where you put it all together and really plot out your long-term financial sustainability for the next 10, 20-year horizon. These plans are also important components for loan and grant opportunities because they show your utility has associated reliable cost estimates with anticipated capital improvements. Although capital improvement plans can be beyond the capacity of smaller systems, it can be helpful to study the capital improvement plans of larger systems as you develop your own asset management strategy. So just in finishing up today, and again, I apologize for the technical issues. Thank you for staying on with me today. This is a tool that we offer through the UNC EFC website. We call it our Plan to Pay tool. So if you have some long-term capital asset plans or needs, and you have some cost estimates associated with those plans or needs, you can use this tool to understand what kind of savings or debt or combined strategy you would need to employ to pay for those long-term needs over time. So we're right at 2:01 p.m. Again, if you have questions or feedback, feel free to reach out to me at abwaters@unc.edu. Here is the EFC website address. There are lots of other resources on our website as well that you may find useful for your long-term financial resiliency. Thank you for your time today. Amaya, are we going to try to do questions or do we need to wrap it up?
I do not see any questions here at the moment, but I'll
Okay.
give another few moments if anyone has any to roll in.
Okay.
If you don't have any further points to add today, I want to thank you, Andrew, for sharing your expertise with us today. And thank you, everyone who attended, for being patient with us. Just to reiterate, you'll be getting a follow-up email with the slides from today and a link to the recording. If you are ever so inclined, please fill out the evaluation form for this webinar. I do not see any questions, so thank you all again, and we hope to see you at a future EFCN event.
Thanks a lot, everybody.